Hello, I'm Dan Passarelli of MarketTaker.com, here on the floor of the CME Group. Well, every day we have a class, a live webinar class, called the Market Taker Live Advantage Group Coaching. And in that class, we discuss about 15 different trade ideas for the day. And today, we talked about Twitter, symbol TWTR, of course. So take a look at a chart of Twitter. Twitter recently broke above $48 a share. That was yesterday, and it closed above that price. That price was an important pivot level. It was a resistance level, which now has become a support level. Now, in this strong market, and with a breakthrough like we saw in Twitter yesterday, I believe that that stock can continue heading higher. Now, the question, of course, is how to play that with options. That's always the question. And in order to answer that question, traders always need to go to the volatility. Should I be buying options here? Should I be selling options here? The only way I can answer that is to see if they're cheap or expensive. And the only way I can answer that question is to look at the volatility. Now, in this case, the implied volatility is very, very low. It's low relative to itself. It's low relative to the actual historical volatility. So options are cheap. So I'm okay with some sort of positive vega option buying strategy here in this case. The trade I like is buying the 47.550 bull call spread in the September expiration series. Now, the reason I like that trade is because those 47.5 calls are in the money, giving my spread a pretty high delta, which means the stock, when it goes up, I'll profit on a pretty good basis with each tick that the stock rises. I have limited risk because it's a spread. I can buy that spread for about $1 right here, maybe even less. The options are cheap right here. Usually with these sort of spreads, this is a bull call spread, there's always a trade-off. I limit my profit potential, but in this case, my target price on the stock is $50 a share anyway, so if I'm selling the 50 strike as part of this bull call spread, my profits are only limited above 50, which is my target anyway, so I'm okay with that. All in all, this is a very well-constructed trade idea. It's got limited risk. I'm buying cheap, underpriced options. I can get a nice leverage profit because I have the spread and the high delta, and as far as giving up upside, that's not really an issue here for me with my thesis on this trade. This is Dan Passarelli here on the floor of the CME Group. Trade well.